So options, think about it like a rental property. When you own a property, right, you own it and then you rent it out, right? You buy a share, a blue chip company or an ETF, let's say it's for £100, and then you rent them out. There are people out there who want to rent out your shares. There are people who will pay you the 1 to 3% per month to rent out your shares. And that's through what's called a call option. So you own the share and you rent out your shares through call options. Okay. And typically, let's say an option, if you buy the share for £100, your option will earn, say, £1.50 per month. That's 1.5% per month. Okay. Now, a call option, are you guys familiar with rent to own agreements? Yeah, with property. So rent to own agreement is somebody who rents your shares or your property and then has the option to buy them at a future date. Okay, so that's what a call option is, right? And then you do that, and then it's just rinse and repeat. You follow these 5 steps, which I'm going to show you put some numbers to it, and you rinse and repeat. That's the beauty of options. It enables you to rinse and repeat. So all of this options income is tax-free if you have a SAS or a pension. It's tax-free. You can't do it in an ISA, unfortunately. So you can't do it in an ISA, but you can do it inside a SAS, which is tax-free. And it's pretty passive, right? It's not as passive as set and forget, as we were talking about earlier, but there is minimal ongoing management. So that's how options work, right? So think about it like this. Put some numbers to it. You buy shares for £100. Let's say it's whatever it is, Microsoft or Apple or whatever your favorite share is, okay? Then you rent it out. You sell your call option, right? That rent-own agreement. You get £1.50 or 1.5%. And these are monthly income amounts, right? So you get 1.5% per month. Now what happens, initially you bought this for £100, right? This share. And when you sell the call option, you have a strike price. So you say to your tenant buyer, you say to your tenant, well, look, I'm willing to let go of these shares if it gets up to £105. You bought it for 100. If it gets to 105, you're willing to let go at £105. But you want to receive the option premium in the meantime, which you'll get. So that's your initial option agreement, okay? Now, what happens if the shares don't reach £105? What if they don't get to that level? You just keep the shares, you keep your 1.5%, and then you just go again, you rent again. If they do go above £105, you still keep your 1.5%, but now you have to sell your shares for 105 because that's your strike price that you agreed at the outset. Okay, so you have to let go at £105. You get that £5 capital gain and you get to keep the shares. Okay, so that's the ideal scenario. You get most upside if that happens. But if it doesn't go to 105, you still keep your options premium. Okay, and if that does happen, you lose your shares and you go back to square one. And this is what's called a covered call option. Okay, so there are 2 types of options. One is a put option, one is a call option. The one we've just looked at is a call option. Okay, and they kind of work in similar ways. You still get the rent, etc. So this is how a lot of people do their call options. We're going to do a demo on this live on the system. Now, look, in this scenario, we've just lost our shares because they went up to 105. That means we had to sell them at 105. Okay, now you're back to square one. You don't have any shares, right? So you need to still keep earning income, but you don't have an asset. So you need to go and buy more assets. So you can buy more assets at 105 if you wanted to, or there's a smarter way of doing it, but you can do it through selling put options. Okay, and this is like going to an underwriter, like an auction house. So you can underwrite your favorite property, your favorite shares, and say, I don't want to buy at 105. I'd rather be buying at 102. So what you do is you sell a put option with a strike price of 102. Okay, so that's how that looks. You earn income for doing that. Okay, you get 1.4%. If the share price goes below 102, then you keep your money anyway. You keep the 1.4% anyway, and then you get assigned those shares. You get to buy them at £102, your strike price. And the risk here is that it drops much below 102, but these are shares that you would have bought anyway. So if you're buying them below the original market price, you're happy. You'd rather buy at 102 rather than 105, right? And if they go above 102, nothing happens. You get to keep your 1.4% anyway, and you just go again for monthly income. You rinse and repeat. You go back to square one. And that's in 2 slides how your option strategy works. When you put the two together, and we explain all this in a much more sort of slower step-by-step fashion, but this is, I'm just giving you the full process in 5 minutes. Okay, so when you put the two together, both the call options and the put options, it becomes the options wheel strategy. Okay, it's a very conservative approach. It's safer and it's more conservative than buying the shares in the first place. Okay, so you acquire the shares, you receive income, you've just done the covered calls, they get called away, you sell put options, your shares get assigned, and then you rinse and repeat. You keep going around this wheel, okay? Sometimes going around this wheel takes a week. Sometimes going around this wheel takes a month. Sometimes it takes 2-3 months, okay? But the key thing is you go around the wheel, and it's a really conservative approach. So let's just do that demo. Let's just fire up our options platform, which is Interactive Brokers. Everything I demonstrate here is fully covered in the Investment Academy, module, which you'll be part of, right? So QQQ, if anyone is not familiar, it's the NASDAQ index ETF, the NASDAQ ETF, right? So you can do QQQ. Just a quick tip, there is one that is even better than QQQ. It's called XLK, right? Does exactly the same job, has the same stocks, Microsoft, Apple, etc., but it's cheaper. Okay, so but let's just do QQQ anyway. So you just type in QQQ, and it's the one, here it is, the NASDAQ ETF. Okay, then you go to options over here, right? And there's a load of numbers here. That's the first thing. Don't be put off by seeing all these numbers. You'll soon realize and you'll get to grips with all of these numbers. It's not as scary as it looks if you're first time to this, okay? There's a very simple system to doing this. So what we do, we normally like to do 1 month options, because if you like receiving monthly income, right, it makes sense to do 1 month options. So we've got QQQ here, which is what we said. It's trading at $475 per share at the moment. And you can see along the top here, you can see all the expiry dates, right? And what we want, we're looking for something that's 1 month out. So we just have to scroll to the right to find something that's 1 month out. You can even go out sort of 157 days. You can see here. There's one here that's 31 days out. So that's perfect, right? This one expires on April the 11th. So this is us doing an option to earn 1 month income, monthly income, over a period of 31 days. So let's select that one for a start. And then what we are doing is we're looking for put options, right? So let me show you. So here, call options we're looking for, right? So we're looking for call options here, right? Because remember, we're renting out our shares. So we are assuming we already own 100 shares, okay? And if you don't own 100 shares, you have to own 100 shares first. And then you just sell a call option on it. So if we had bought our shares for, let's say, $475, right? We can sell our call option for, say, $480, okay? So here's our strike price, right? So what this implies is we are willing to let go of our shares at $480, okay? So we're happy to let them go at a small profit. But what we're going to earn as a result of that is what we see here is the options premium. You can see here, you're going to get $14.20 per call option we're going to sell. Now, what does that mean? Okay, we're going to get, as a percentage, it's $14 divided by the current market price, which is $474. So I make that about 3%. So in the space of 1 month, you're going to earn around 3% premium. So that's what we're going to earn, right? 3% in 1 month for renting out our shares on QQQ. It's as simple as that, right? So let's just go ahead and do it, because this is my paper trading account. So when you learn options, you have a paper trading account, which means you don't put your real money in it. You're just doing it to learn, right? So it works in exactly the same way. The only difference is it's not your money, it's kind of paper money, right? So let's do that one, which was at 480, this one here. which is what we identified. So you click on it and it brings up an order ticket on the right here, right? So you do that and you press order, the blue button here. You just make sure you're doing everything right. So you're selling here, which we are. We're always selling options. To make income, we are selling options, okay? We make sure it's on the right one. And by the way, we're going to get, as income, we're going to get 100 times this because options come in batches of 100, okay? So we wouldn't ordinarily do QQQ because it's quite an expensive stock. Or you might do if you've got a big enough account. You might do. But if you did one option on this, you'd get $1,440, right? 100 times this, right? 100 times 14.40 would give us $1,440. Okay, so this is how it works. This is the order ticket. You make sure you're selling one contract here. You do a market price here, and you literally just press sell order. As soon as I press this sell order, and as soon as it says order filled, your account will be better off by $1,440. My account will be better off by $1,440 as soon as it's filled. Your order has been filled. So we did that on QQQ. We sold there it got filled at $19.49, and we've just earned $1,427. Okay, so that's as simple as it can be. We need to select the right strike price, which I just did a shortcut of the process. We have to select the right underlying. Okay, QQQ, which is what was a suggestion, and the 480 is we have to go through a process. You don't just have to do this on shares, you can do it on commodities and gold and silver and things. So SLV is an ETF on silver. If you like the look of silver, you can see how it's been doing. Silver and gold have both been outperforming stocks of late. Wasn't the case last year, but it is now. So it's actually up on the year, right? Silver is up on the year, as is gold. So silver can be another one of your protection assets. So here's silver. And this is a bit more realistic, right? Because it's $30 per share, right? So let's go into options. And so market closes in 8 minutes. So we're in good time, actually. So again, same process. Let's find something that's 30 days out. So we've found silver. Let's go with 30 days out over here, right? So I can see that. So let's click on that one. 30 days. Sorry, that's 20 days. Sorry, 31 days out. And let's assume we already own 100 shares of silver. So we're going to sell a call option on that now, right? So let's say we bought that at $30. We had bought that for $30. So we look for something that's about slightly above market price. So let's have a look at, so this one here, we'll go for the one that is $30.5. Okay, so we still make a slight capital gain if we have to lose it. So we're going to get 74 cents. 74 cents divided by $30 it's about 2.3%. So we do that. We pull up an order ticket, sell one, sell it at market price. And let's just get this done before the market closes in 6 minutes. Hopefully that will be done. And we're going to earn less on this because the market price on this is a lot lower, right? So we might end up, so we've just been filled, order has been filled, so that's great. In reality, we might do several contracts of this. We've only done one of this, right? So we might end up doing several to make it a more meaningful trade for us. Okay, so we've done that. And we go to trade, orders and trades. And again, same process. That money has just dropped into our account. The beauty of options, you get that money in your account on day one. You don't have to wait for a full month. It's sitting in my account right now in cash, right? So we've just earned that $74, right? You can see here, $74. And as I said, we can do several contracts of these. So in 5 minutes, we've just done this one and we've done this one. And we've earned about $1,500 just by doing those two trades, okay? So, and I've abbreviated the steps a little bit, right? Just for the sake of time, but essentially, this is how quick and hopefully you find it relatively simple, the process is for earning options income. You need to open up an account in the first place, but we give you all the steps to do that. So the delta is a concept that enables us to select our strike price. So we selected the strike price 30 and 480. So what will inform us of our strike price is the delta. The delta will inform us of our strike price. Typically, it's about 25 or 30 is the delta I use on this, but it depends on what price you acquired the shares at and other considerations like that. So for regular puts, it's 25 or 30. So MicroStrategy is a very volatile stock. So I reckon we're going to get premiums of close to 10% per month on this, I would guess. I haven't done these for a while, but let's just have a quick look. Okay, so if you go to options, we won't go through the full steps, but let's just have a look at the price. Go 31 days out. Okay, and you know the process by now, right? So we just go with, right now the market price is 260. Let's just go with something like 270 is the strike price. And you can see here, you get $26 per share, 26.65, and the market price is 261. So that is pretty much 10% in 1 month. So if you're brave, and I wouldn't do it on MicroStrategy, the rule here is to do it on ETFs. When you're starting off, do options on ETFs only. Don't do it on individual stocks because individual stocks are quite choppy. Okay, but you can see here, it's 10% already just for 1 month. Okay, so you can get stocks which give you options that give you super high monthly returns.